So buy-to-let mortgages, what are they? So simply put, a buy-to-let mortgage is basically where you're getting a mortgage out on a property that you don't intend to live in. And they differ slightly to normal mortgages in quite a few different ways, so make sure to get your pen and paper ready and we'll go through those. Now there's three main areas that we're going to go into in this video, and the first one of those is mortgage interest rates. So if you go ahead and you get a residential mortgage on a house that you're going to live in, what you're going to find is the interest rates that are applicable to you that you can go ahead and apply for are going to be a lot lower than the interest rates on a buy-to-let mortgage. And there's several reasons for that, but the majority of the reasons all come down to the fact that having a buy-to-let mortgage is a lot riskier than having a residential mortgage, because from the bank's perspective or from the lender's perspective, you are obtaining credit on a second home, essentially. So that again differs from the main home that you're going to be living, which is going to be your residential address. So again, buy-to-let mortgages are where you're buying a property and then you're going to be renting that out, and that could be a commercial property where businesses rent those premises, or it could be, again, a residential property where people live in and that's their home. So when you first start looking at interest rates with buy-to-lets, it's really important that you shop around. And here are a few examples that I'm going to just pull up here for you. So there's different ones that you can choose from. You can choose from what we call a tracker rate, or you can have a fixed rate or a variable rate. For example, it just depends also on your circumstances over which ones you can actually apply for. Now, a fixed rate is going to be fixed for a certain period in time. It could be 2 years, it could be 5 years, it could be 1 year, potentially it could be 10 years. Or a variable rate is where your rate's going to change. If you think that the market rate is going to go down, you might be more inclined to go ahead and pick a variable rate. But if you're not sure, then maybe you might want to look at a fixed rate, for example. So let's move on to deposits. Now, with a normal residential mortgage, if you're going to get that on your own house, you're going to find that the deposit required could be anywhere from 5% upwards to 40-50%, how much you want to put in, but usually they're quite low compared to buy-to-let. So 5%, 10% is usual, particularly in 2024. But what you'll find with a buy-to-let mortgage is that those deposits required are a lot higher, and they can be 25%. So if you're looking online and you've seen all these different rates and wondering what on earth do they mean by the terminology such as 75% loan to value, what that means is you're going to have to put down a 25% deposit on that property. If it's 60%, then that means that you're going to have to put 40% down. So when you're checking out rates and you're wondering if you can afford a specific rate over another, you need to take that into consideration because they are a lot higher. The other thing you want to be careful of when you're picking a mortgage rate is the length of the term of that mortgage, because again, that can differ. So it might be for 10 years, it might be for 20 years, or it might be for 30 years, for example. So you want to take that into consideration when working out which mortgage rate you're going to pick from. And there is a bit of a difference again with dealing with the banks with a buy-to-let mortgage compared to other mortgages, because they can't advise you over which rate you should be choosing. They can provide you with a list of rates, but that's as far as that gets. So you have to do the calculations and work out which one of those rates are going to be more applicable for you that you can afford. The other thing with interest rates with a buy-to-let mortgage is that there's also additional fees that can apply with certain mortgage rates that you're looking at. So they might have, for example, an £1,800 conveyancer fee on there, or a solicitor's fee, for example, which is going to bump up the price of that overall cost of that mortgage. And sometimes you have to pay for that in advance. You can also, in some circumstances, spread that across the entire length of the mortgage, so that you just contribute towards that monthly, for example. But again, read the small print and make sure that you can afford the mortgage interest rate that you're looking at. Now lastly, when it comes to a buy-to-let mortgage, which is again why they differ from a normal mortgage, is because the lender is going to go ahead and run through a lot more checks than normal if you were to just go ahead and be buying a residential property for you to live in. And that's because, again, from their perspective, from the bank's perspective or the lender's perspective, it's a lot more riskier than a normal mortgage. So they're going to ask for much more information from you to support any funding that you've got, any lending, etc. In that process. And it can feel sometimes like you're pulling teeth in that process, because they just ask for everything. So what I'd say is, if you're going to go ahead and look at buy-to-let mortgages, make sure that you've got your ducks in a row, because they're going to want bank statements, putting documentation behind your pay, so pay slips, P60s, etc., the works. So make sure you're prepared for that if you're going to go ahead and start looking at a buy-to-let mortgage for a property. So I hope all of that helps, and I'll catch you at the next one.